you're kind of like me. You like coaching basketball for the kids. I
do.
actually registered yesterday to coach my son in flag football, so I feel
I've
like a
done
good
that
dad
too.
for a day. Yeah.
Yeah, I've done lots of flag football coaching too. It's fun.
With the little ones, it's like there's only like 3 routes that we run. 'Cause it's like I'm not. Yeah, we can't do too many complex schemes going on. But yeah, we won a grand total of 2 games last year. So I am not the best coach of all time.
My
pretty
12-year-old
good.
likes basketball, though. Yeah.
Oh, really?
Does he?
What position?
I don't know.
Does he bring down the ball? Does he point
They're all the
guard?
same.
Oh,
now.
he's defense.
Defense. Oh, he likes
Yeah.
to play defense.
Yeah.
Well, I'm hopefully he's playing offense too when he's out there.
That's a skill, though. I think just knocking the ball.
So what is the origin? You have a really cool first name.
Oh, Saray.
Saray.
I am Chinese.
Oh, no way.
Yeah. So in Chinese, it would be Chen Siray. But phonetically, since it's spelled, and for some reason my mom put a U, so it's just easier to say Saray.
I
And I'm
think
used to
Saray
it.
is a really cool name.
Thank you.
So there you go.
Yeah.
Yep.
It
That's pretty
means
good.
seeking intelligence
Wow.
in Chinese.
Cool.
All right.
That's great.
Well, we're going to play that out right now with Ben. We're going to try and seek some intelligence. So I'm fascinated about your career. So, like I've heard of Peterson Partners for a long time, Peterson Ventures for a long time, but I always kind of got muddied in my head. Like, what's the difference?
What's the
Is it
difference?
just like a DBA or what's going on? But now I'm learning from you for the first time that Peterson Partners was more of a private equity firm, and then you started a venture more earlier stage right now, and that's kind of, you've been there for 15 years, is that?
Yep.
Is that right?
That's right. That's
Okay,
right.
so give me a little bit of the history on Peterson Partners first. I know you weren't there as much, but
Yeah. So Peterson Partners was started. So I'll talk about our founder, Joel Peterson.
Okay.
A little bit of history there and how the firm came to be. So he was with a firm called Trammell Crow, which was at the time one of the largest commercial private real estate firms in the country, based out of Dallas, Texas. He was the managing partner there early 90s after a long career, and then started teaching at Stanford Business School in 1992. And I'll talk about why that's relevant to our strategy here in a little bit. But in 95, he left Trammell Crow, moved to Utah, which is where his wife is from. He went to school at BYU, set up a family office, started diversifying wealth out of real estate by investing into private companies.
oh well.
Eventually, in early 2000s, started bringing on outside investors into that investment activity.
Yeah.
So some of the early investments they made were JetBlue, which we're all
David
pretty
Neeleman.
familiar with.
Yep.
David Neeleman, who subsequently Peterson Partners has backed 3 different times in 3 different airlines: JetBlue,
Did they do this
Azul,
new one?
and Breeze.
Breeze,
Yes, absolutely. And so that became Peterson Partners. Peterson Partners has been a lower middle market private equity fund looking to invest in businesses with 10 million to 50 million in revenue, and 2 million or more in EBITDA or cash flow typically.
Yeah.
And that strategy has done really well. They just announced the close of their 10th fund. When I joined the firm originally in 2010, our founder Joel would do some investments into early stage companies off his own balance sheet, really kind of angel investing. So the question that we kind of looked at together was, is there an opportunity for us to have a strategy that is investing in early stage companies and venture capital businesses, but do it in a way that we could bring on outside capital like they were doing on the private equity fund?
Yeah.
And so that's what we did. We started laying the groundwork for that. We eventually raised our first fund in 2012. We started investing in early stage companies, and we based our strategy off of 2 core components. One is investing here in Utah. It's where we were based. Peterson Partners is actually the oldest private equity firm in Utah.
I was going to say 90. Well, if 95 would have been super, super early.
Yep.
In fact, I think maybe, who was the other one? There's maybe Swanson, was that?
Yeah.
Probably the other
Yep.
existing, yeah.
Yep. And so there was an opportunity that we believed to capitalize on our presence here in Utah.
Yeah.
Just believed the market was undercapitalized. There was a lot of opportunity to back founders, back entrepreneurs, but that there wasn't as much capital as there needed to be here. So we believed there was an opportunity to do that. And then second, we, with our founder, Joel Peterson, teaching on campus at Stanford Business School, that was also an opportunity for us to invest in back founders starting interesting businesses.
Oh, yeah.
And so, like any business, we're always trying to figure out where do we have a competitive advantage. And for us, we believe we have a competitive advantage in those ecosystems, opportunities to invest in founders starting interesting companies. And so that's what we did. We raised our first fund in 2012 on that thesis.
What was that fund? What was the total? And
So we raised a $25 million fund. So small fund, but at the time, a lot of seed stage funds were around that size. Somewhere, anywhere between 20, 30 million was a pretty typical seed stage fund.
now you're in the hundreds of millions, I'd imagine.
So our most recent fund is a $115 million fund that we're investing out of. So we've now raised 4 funds around this strategy and continue to invest in
I've got a
great
question
businesses.
on that.
Yeah.
So it's always been fascinating for me on how private equity firms, venture capital firms go after high net worth individuals to be a part of the fund.
Yeah.
Could you tell me about that process?
Yeah, so from a fundraising perspective, we're looking for a couple of things. We're looking for partners that we feel like are aligned with us in terms of how we think about investing. They believe in our strategy, so they believe in the ecosystems that we're investing in. And so there are different types of investors that we'll bring on. And one of those, like you mentioned, is high net worth individuals. And I think there it's an opportunity for individuals to invest with us and get the benefit of the work that we do.
The sophistication of a team behind it.
So our full-time jobs is to look for investment opportunities, evaluate those opportunities. And so they get the benefit of that work and also the diversification of investing in a fund. So that's the case with us, it's the case with any fund. And I think that's one of the benefits. Get lots of exposure to different things and get the portfolio diversification that comes with investing in a fund.
Ben, what I'm gathering too is I'm not from Utah. I've been here for 8 years, and being an outsider, I think it's so impressive that Utah has so many of these organic companies. And I think what I'm also hearing is that your investors and your footprint has made a big difference here.
Oh, yeah.
Silicon Slopes, wherever, and you're finding these people from the ground up, and even in the classrooms.
Yes.
And I think that's what you mean by ecosystem. From the very, very beginning.
Yeah. I mean, we'd like to. We hope so. We hope that we're contributing. At the end of the day, we feel like I'm a believer. You talked about coaching basketball. From my perspective, one of the way I think about investing is, I believe that the players win the games.
Yeah.
Hopefully, as coaches, we're there to help provide some guidance, some directions. But at the end of the day, it's the players who are on the court.
So you're betting on the entrepreneur.
And so, in terms of our ability to impact the ecosystem, what we hope that we're doing is we're providing some capital. Hopefully, we provide some guidance. We bring our network to bear, and then hopefully we are helpful in the process, and we provide support to the founders. At the end of the day, it's the founders who create the value, and but it's our privilege to be alongside them as they do that, and hopefully we can provide value to them in that process.
Are you primarily focused on tech and secondary CPG and retail?
Yeah, so it's a great question. So the way we've thought about our investment strategy is we kind of think about it in a 2x3 matrix.
Yeah.
So in that matrix, we think about where do we primarily source opportunities from. So we talked about Utah. About 40% of the deals that we do are here, so it's a really important part of our investment strategy. But Stanford Business School, so about 40% of the deals that we've done over the years have been tied to Stanford Business School in some form or fashion.
Is that where you found Joel at Allbirds?
Yes.
Through Stanford?
Well, the third piece is referrals from our CEOs.
Oh, okay.
So we believe strongly, as I've talked about, in partnering with founders.
Yeah.
So we actually, like a consumer brand, we actually track our Net Promoter Score every year. So we go out to our founders every year and we ask them, how are we doing relative to your expectations for the value that you expect us to bring?
Oh, cool.
And we do that every year. It gives us an opportunity to get feedback from our founders that we back, and we learn a lot. But also what we found is if we can do a good job in that role, that founders will come back to us, we'll have an opportunity to invest in them again, and then founders will send people they care about, so other founders they know our way. And so that is the in terms of how we think about sourcing deals. And then historically, we also have invested in a lot of software as a service businesses, which has really kind of historically been the bread and butter of Utah.
SaaS, yeah.
And then also what we call digital commerce. And I can talk about how digital commerce has evolved for us over the years. But early in our fund strategy, digital commerce for us, a lot of that was investing in digitally native brands or D2C retail businesses.
Can you give an example?
Yeah, so
Tundra, right?
Yeah, so we're invested, one of the companies we've invested in is, so you asked about Allbirds.
Yeah,
So we
Allbirds,
invested in Allbirds. We were first investors into to that business.
Yeah.
And the way we actually found that business is one of our other companies we invested in, Davis Smith at Cotopaxi.
Oh, yeah.
He actually referred us to talk to another founder that we ended up not investing in the business, but we developed a good relationship with the founder over the course of the due diligence that we did. And that founder actually introduced us to Joey and Tim at Allbirds.
Oh, yeah.
And so that's how we met Joey and Tim. So really roundabout referral from one of the founders in our portfolio.
I saw him at the, I met him at what was it, the Crossroads of the World Summit, the Zion Summit.
Oh,
He
interesting.
came in here and he was speaking with Jeremy Andrus and some of the other people. It
Good.
was kind of like it's kind of funny watching Jeremy Andrus interview people. Like it's like, Jeremy, I'm pretty sure you're the one who always gets interviewed, right? Because he's
Yeah.
with Traeger and Skull
Yeah.
Candy and everything else. But I actually saw that he was there with the big Olympic announcement that we're getting the Olympics,
I know,
which
I
is kind
saw
of cool.
that, yeah.
But yeah, I mean, so you've had Allbirds, but also Bonobos. So you have two
Yeah.
footwear companies.
Yeah, so Bonobos is largely men's apparel.
Oh, Men's Apparel.
Men's apparel.
Do they do footwear at all?
So I don't think they've done footwear. They've typically partnered with other companies to provide footwear.
Okay. So
But
so
they're
mostly
mostly
shirts and
men's
stuff.
apparel.
Yeah.
Yeah, men's apparel. And so Bonobos, Bonobos, I think a lot of people talk about Warby Parker, and rightly so. Warby Parker did a lot to really pioneer direct-to-consumer brands.
Yeah.
But Bonobos, I believe, and Andy Dunn really pioneered a lot of what we're seeing with direct-to-consumer brands today. So Andy
Yeah.
started off selling men's apparel. Started off with men's chinos. He had this insight. He and his co-founder Brian Spaley had this insight.
Oh, that's right.
That, you pull your belt off, and if you hold your belt up, you can see your belt has a
Yeah.
curve to it.
Yeah.
But most men's pants, not the case a lot of times with women's pants, but men's pants were straight around the waist.
Yeah.
And so one of the things that they did is they just tilted the front of the pant down and made it fit a more natural fit.
Oh, smart.
Yeah,
So it's not as stiff. So
not as
it's a little
stiff,
bit more
fits your
flexible.
body a little bit
Good
better.
job, Bonobos.
That was the original insight with Bonobos on the men's chino. Then they took that men's chino and they built a full men's apparel brand around it.
Oh, wow.
Eventually sold the business to Walmart. We learned a lot in that process. They pioneered, I think, a couple things. One that we think a lot about as we think about brands, and I think this applies not only to direct-to-consumer brands, but other places as well. But really focus a lot on a hero product. So what is the thing that you are known for?
Yeah.
So for Bonobos, it was the men's chino pant.
Yeah.
Right. Then you can take that hero brand and you can build on top of that.
Yeah.
For Allbirds, it was their Wool Runner, the product that they released right at the outset. Shoe made out of merino wool, which was unique, differentiated. People didn't know about that before, the ability to make a shoe out of that product.
That's the differentiator. Yeah.
And it created differentiation. So
Oh,
one of the
interesting.
challenges is you have to differentiate amongst the noise. There's a lot of noise out there. There's a lot of brands. And so having that hero product is really important. So it's one of the things that we've looked for over the years. And then I think the other thing, if you look at Bonobos, pioneered what Andy Dunn eventually came up with this terminology, digitally native vertical brand. And what's interesting about these companies is they're digitally native. So their primary mode of sales is direct to consumer over the internet.
Yeah.
But over time, I think one of the things that Andy realized was in order to really scale the business, we're going to have to go omni-channel. So what he started doing is he partnered with Nordstrom. Nordstrom started selling Bonobos pants in their stores. And so he opened another channel, which was third-party retailers. And then lastly, he started getting a lot of people coming into, like, calling and saying, hey, we'd like to try on the pants. So we'll just order them. That's what, that, you know, if you don't like them, send them back. Like, no, we want to try them on. So he started inviting people into their store, their headquarters in New York, having people try on their pants. And he noticed that the conversion rate was significantly higher. People were buying more. And so eventually that led to Bonobos opening their own branded Bonobos stores.
Oh,
So
interesting.
brick and mortar
Brick
instead
and mortar
of direct.
stores.
But that probably isn't a case for every kind of business.
Yeah, not every business, but I think what we've learned over the years is that most of these businesses, if you want to scale, eventually you need to have an omni-channel strategy. And so all of the companies that we've invested in that we're looking to grow to 100 million plus in revenue, eventually will have all three of these components. So they're digitally native, so primarily selling, primary sales channel is online direct to consumer.
Yeah.
But they also will develop some retail partnerships. It depends. Every brand is going to have different retail partnerships that are preferable to them based on their product and strategy. And then ultimately, most likely will end up opening some of their own stores.
I bet you've
proprietary
seen
branded
it
stores.
go back and forth, especially with the pandemic. Do you start with direct and then you go to brick and mortar, or did you start at brick and mortar and then you had to go to online and then back and forth?
Yeah.
You've probably seen it all different ways.
Yeah, that's the whole interesting thing about going to Nordstrom's and then eventually opening a semi-related line to Walmart. You don't see that hardly at all, which is crazy. So was the Bonobos, is it under a different brand? Was it a different brand when it was in Nordstrom's compared to now selling to Walmart?
No, so Walmart actually acquired the business.
Oh, they acquired the business,
So
but they're
they
not selling it in
acquired Bonobos.
Walmart.
Yeah, they're not
Okay,
selling
so
it.
that makes sense.
Walmart had a strategy which they've since gone away from a little bit, but was to acquire several of these brands.
Oh, I did not know that.
Yeah.
Oh, interesting.
So they acquired several of these brands, one of which was Bonobos. But they didn't sell the Bonobos product through Walmart.
Okay,
It was,
wow, I did not know
an
that.
acquisition strategy by
Wow.
Walmart, and which was really interesting.
Yeah.
Kind of an experiment that Walmart did at one point in time to think about expanding their e-commerce strategy. But yeah, to your point, I mean, really interesting to watch what happened to
Yeah.
sales in e-commerce in general during the pandemic and after. I think one of the things that's been really interesting with the pandemic from a venture capital perspective is the pandemic unexpectedly ended up being a real boost for venture capital businesses in general, because the business, if you think about it, most venture capital businesses are based on technology, and they're built on the ability to provide value through the technology. And so e-commerce is the perfect example of that. E-commerce really took off. Obviously, there was less shopping in stores, more shopping online. And so we saw during that period of time tremendous run-up in all e-commerce businesses. I think there's multiple reasons for that. But we also saw it on the software side with a lot of companies buying new software, trying to figure out new challenges, dealing with remote workforces. So I think unexpected to a lot of us, it ended up being a real boon.
That's a
for
great
businesses.
point. I have this thing, Retail Collective, that we're launching, right? So, businesses that make over 20 million in annual revenue, their CEOs and CFOs, they meet together quarterly. It's interesting because before the pandemic, that number that they were making over 20 million, I'm guessing was less than 40. Now there's over 80. And because a lot of these direct-to-consumer brands really did take off. I mean, if you look at a lot of the big notable ones, they weren't even around in 2018. Like you think about, I can name 1 million of them, Just Ingredients. Bucked Up had just barely started. There's so many of them that were just starting. Mixer started probably 2019, but now a bunch of them have already hit over the 20 million mark. It's pretty interesting what the pandemic did, because the biggest fatal flaw in retail, well, my biggest thing, and I always talk about this, is always make sure if you have a retail brand to do direct to consumer first until you have maybe 10 million in revenue, 20 million in revenue, and then go to brick and mortar. But the problem is a lot of people don't understand that strategy, so they try to jump into brick and mortar right off the bat, and they can't fund it. It's too expensive. It takes too long. It's where all the big money is, but you have to do direct to consumer first. You can't just go straight into brick and mortar and then hope for the best. Otherwise, you can suffocate pretty quickly. So it's, I think, why you saw so many brands flourish is because they're forced to take the route that was better for them anyway, and they just didn't know it, right?
And I like that middle ground of having that third party where, and I have seen some local businesses say, well, I'm going to set up shop in your Target or in your gym and have that clothing line, and that way you can kind of test the market. But I had a question of, if you are here in Utah, you are a startup, or you're in that Stanford classroom, how do we pitch to you?
Yeah.
What is the selling? Do you have headhunters? I'm sure you do. But also, with that ecosystem, how does someone entice you guys?
Yeah, it's a great question. And so I think the way we approach it, we have, for the most part, we have an open door policy. So I think what's interesting about seed, and I'll talk about what we mean by that, but what's interesting about seed stage in when the stage at which we're investing is there's no database for us to go out and mine and figure out who's going to start the next business.
Yeah, and they're all private companies.
So ours is very much focused on relationships, and very much around network. So our first job is to sort of make sure people are aware of us and who we are. So when they look to start a business, they think about us in addition to the other opportunities. We've got a great group of investors here in Utah. I think since we started in 2012 with our first fund, really a lot of capital has come into the state with funds based here in Utah as well as outside of Utah. So I think now there is a lot of capital, or a lot more than there was, and the great opportunities for founders to go out and raise capital. So first job for us is to make sure people are aware of us, who we are, what we do.
So your own branding.
So our own branding, yes, which, I don't know if we're good at, but one of the things that we focused on in from our perspective is really focused on working with the founders that we have backed, hopefully deliver value to them in a way that they feel good about the partnership. And then they often will tell other people. So word of mouth has really been a lot for us. And then we get referred into those deals. We certainly will have people who reach out to us without a referral, and we do our best to process those. But I think when we feel like there's a potential fit from a strategic perspective, we want to at least learn what we can about the business to make sure, to see if it is a fit or not. I mean, ultimately, we, just by sort of law of numbers, we can only invest in a certain amount of the companies that we see, but that's the process that we try to follow.
That's a question that I had is, we had Suze on from Pelion. Awesome person, super competent.
Yep,
and
Suze is great.
Yeah, great person. She was saying that in the last, I don't remember the exact timeline, but I think Cassie posed the question, how many companies have you seen over the last 5 years, and how many have you invested in? And I think she said, I think it'd be like 1,000 and maybe 5. Wow. Is that kind of the same?
Per year, probably is what
probably
she's
per
saying.
year.
Yeah.
It's probably per year.
Yeah.
Is that kind of the same ratio?
Yeah, so we'll invest in somewhere between 8 and 10 companies a year.
Okay.
And then, certainly the number of deals that we'll see, when you think about the companies that we get referred to, we spend time at demo days to, see companies that are presenting. Partly that's to identify opportunities, partly is to understand trends that we're seeing in the market. But we'll see, 1,000 companies over the course of
incredible
time that we're looking at opportunities.
Are there any that you wish, that one got away?
Oh,
a lot.
A
Every
lot.
time, yeah. So I think, when I one time heard Bill Belichick, from the Patriots say, he thinks a lot more about the Super Bowls that he lost than the ones that he won.
Oh,
man. And I mean, it's just the nature. We will, and I tell founders this all the time, is we get things wrong all the time. So we might say no to what you're doing, but if you have passion, if you believe in what you're doing, you're going to keep doing it,
Yeah.
and you know, you're going to prove us wrong, and that's
Yeah.
going to happen. And I love to see that happen. It's painful, but I love to see that happen because at the end of the day, I think we're champions of entrepreneurs, and I think when entrepreneurs create value, they fundamentally change the industries they're in, and that's cool to see. And so, always happy for the founders. You know, always feel bad that we weren't a part of the journey. But you know, so we certainly miss.
But you
We
get a-
miss.
That's a great perspective, though. Thanks for sharing that.
It is, and I mean, and you've had some major hits. So I think Lucid was one of yours. Is that right?
Yeah,
So
so
you have some big
we
tech
were
ones.
fortunate to invest in Lucid. And I think one of the interesting opportunities there is the first time we saw Lucid, we didn't actually end up investing because we weren't sure how big the market and the opportunity was.
Yeah.
We loved the management team. And that was a big lesson for me because we were fortunate to stay close to the team, and they gave us another opportunity to invest
Oh,
later.
cool.
And I'll always be grateful for that. And so we had an opportunity to come back and invest in Lucid later. And the team just executed phenomenally well. And so by the time they came back and gave us an opportunity to invest, we were very excited to do it. And they were demonstrating there was a path there that we maybe didn't see the first time. So like I said, we get things wrong. But hopefully, you know, we get enough right that it you know, the model works.
Is there one company that sticks out in your mind that so surprised you and you're so proud of?
Yeah, I would say so. On the in terms of the companies that we missed, I mean that list is long. But one of the companies that always stands out to me because it was really early in my career, we had an opportunity to invest in a company called SoFi, which
Oh, yeah.
many people know of at this point. I think there's a stadium in LA. So
Anyone.
the business has done well. They've acquired a couple companies here in Utah, so the business has a presence now. We saw that business really, really early stages. And originally they were, the business model was looking to go refinance student loans at the top tier graduate schools in the country. And they were going to family offices and seeing if the family offices wanted to put some capital into what were really, if you take the top tier, you know, the cream of the crop of student loans, those are really low risk assets.
Yeah.
And so, but they all get priced essentially the same. So the model was really interesting, but the question was, is that a scalable business? Is that scale? Does it become a venture capital scale business? And so we didn't invest. And eventually the team figured out how to solve a lot of those critical problems.
Really cool.
Figured out how to scale beyond just the cream of the crop loans. They figured out how to essentially go get the loans that they were writing and have them and get facilities to cover the debt there in large scale ways, which at the time there wasn't a way to securitize student loan debts. And so it wasn't clear how you would grow and scale that. And the team just, you know, they solved those problems along the way. And so that's one that I wish,
Yeah.
you know, we had an
That would've been a
opportunity
good one.
really, really early on, and they did well.
I'm going to ask you for 2 or 3 different bullet points for the different industries, just so people can kind of
Yep.
compartmentalize in their own heads. So for a tech company like a SaaS company,
Yep.
you're typically looking for something that might be doing $500,000 in ARR, or what are you looking
Yeah, so
for, debt-wise? And
Yeah, for us, over the last 10 years, we've been fortunate to invest in 6 companies that have gone on to be worth, at some point in time, $1 billion or more.
wow,
And 5 of those 6 companies we invested pre-product, pre-revenue.
wow,
So I say that because we have always viewed part of our heritage as investing early. We're investing in founders who we believe have unique insight into a market
Wow.
and have unique insight into the problems and then also how to solve them. And so for us, revenue is indication that's working, but it's not a requirement. of course, we'd love to see revenue.
Yeah.
We'd love to see that customers are buying the product. But when we invested in Allbirds, for example, there was a prototype. They had like
Really?
3 pairs of shoes.
I had
They
no
sent us a pair of
idea.
shoe. They sent us one of the pairs of shoes. It was like a size 9. I'm not a size 9, so I, jammed my foot into the
You're like, in
shoe.
theory, this
walked
is a good
around the
shoe.
office, but it was, genuinely could tell this was just different.
Yeah.
And then, but more than that, we believed in the team, having spent time with them. So, so in terms of criteria, there's no set criteria for us.
Okay.
We will invest pre-revenue, pre-product. We're investing sub $1 million of revenue, but we will invest beyond that. But for us, it's much more about a team that we believe has unique insight into a product, and then or into a market, and then unique insight into how to solve that problem. And we know it's going to be hard. If it's not hard, somebody else has probably done it.
Yeah.
And so then we're kind of overlaying like I said, I've been doing this for 14 years, and I've got great partners and colleagues who have great experience, and so we overlay our experience on the opportunities to try to figure out which ones we're gonna get behind and try to help change the industries they're involved in.
Are you always on the same team, like on the same page with your team?
That's a great question.
Or is it like Shark Tank and you're just like, okay, you gotta
Yeah.
propose, and I'm like, okay, I like this, but
Yeah.
my
Right,
partner
majority
doesn't
wins.
like it,
Yeah.
and so how do you work
Good question.
with each other?
Yeah, it's a great question, and that ultimately that's the art of venture capital in a lot of ways. Our job is to sit around and make decisions about what companies do we invest in, what companies do we invest more capital in, how do we, the decisions and just the ebbs and flows of what happens with the company along the way, and so,
Do you
the
watch
answer
Rudy?
is that what's that?
Do you ever watch Rudy?
Rudy, the
Rudy,
movie? Absolutely.
So
yeah.
he's out there, and Rudy's
Yeah.
out there, and he's trying out, and then you have an offensive coordinator, and then I don't know, a defensive coordinator, and they're deciding which walk-ons to keep.
Yeah.
And then one's vouching for Rudy, and the other one's he's like, if you want him, you can have him. So is it kind of like that, where it's just like if someone's really passionate,
Yeah,
you're
I
gonna be
mean,
like, okay, I'm gonna roll with this guy.
Yeah, I think that. So the answer is that we're going to disagree as we think about making decisions.
Yeah.
And I think that as a venture capital investor, one of our key jobs is to essentially help our partners or our colleagues understand why we think this is an interesting opportunity. So we have to figure out how we make that argument internally. And so that's part of the evolution of a venture capital investor.
Judge and jury.
Yeah, so we have to, now at the end of the day, we also have to trust each other. So if somebody has real conviction, we believe in conviction. So if somebody has real conviction, we might disagree on an opportunity, but we want to commit to it afterwards. So if we decide to move forward, we're committed, and we're going to do everything we can to make this successful. So we will disagree. I think it's healthy to disagree because it helps us to get to better answers. But on the flip side, once we've decided, we commit to that decision as a team. I think that's really important.
So explain to the audience, how does the venture capital firm like yours make money? I'm sure there's a management fee.
Yes.
Like a percentage of what you're raising, the 125 million, and then I'm sure there's a percentage that you guys get on the deal for the ownership of the company. Could you explain
Yeah, so
how?
most private equity venture capital funds have a very similar model, which is there's a management fee, which is typically, it can vary, but typically around 2%. So 2% of capital on an annual basis. And that's essentially our revenue. That's how we pay for our office space, the salaries of our team, our day-to-day operations. And then there's essentially a profit sharing component, which is typically called carry. And that the traditional number there is around 20% of the profits. So our first job is to return the capital that investors entrust us with to go invest. Yep. Once we've returned their capital, then we split the proceeds 80-20. And so the profits, the profit share, 20% as managers, 80% of the profits go to our investor, back to our investors.
That's really cool. It's so tell me how it. Are there like bylaws on how often you have to meet with the potential investors or report back to them? Or I'm sure there's
Sure.
a lot of regulations.
Yeah, so we do. I mean, there's things that we do just because we want to keep our investors updated.
Yeah.
So we have quarterly reporting that we provide to them, that we do typically through a quarterly letter that we provide that provides an update on the portfolio of the companies that we've invested in and the funds that they are invested in. And then we do an annual meeting. So we have a meeting once a year. We invite all of our investors to come out, and we provide an update on the funds and the performance. We'll typically bring some of our CEOs in so they can provide updates on the businesses. Our investors always give us the feedback that they'd much rather hear from our founders than from us, which we don't disagree with. Great to hear from the founders and what they're working on. Kind of feel the energy that they have for the businesses. They're devoting so much time, energy, and effort. And then beyond that, we have lots of touch bases along the way. But those are, like any investor, we're trying to make sure they feel like they know what's happening and hopefully have a sense for how things are performing.
So on the retail side, typically category managers or buyers, they're most known for buying new products, but that's a very small percentage of their actual job. It might be 5% is bringing in new SKUs, and the other part, 95%, is managing current products. I'd imagine it's probably the same thing with venture capital, where, everyone knows you for the new investments, but the vast majority of your work is probably refunding and analyzing all your other investments. Is that correct?
Yeah, so I think about, a couple components to the job, and it ebbs and flows depending on, where you're at in your career or what you might be working on at any given time. But there's the source, evaluate, and invest in new deals, right?
Yeah.
And then once you make the investment, you now have a portfolio of companies. So managing that portfolio of companies, working with those founders, hopefully, as we talked about before, adding value to them and trying to help them accomplish their objectives. And then we have fundraising. So we fundraise as well. So I think that's fundraising's hard. It's difficult, and it's we're also out fundraising. So a lot of people tell us no.
Yeah, you never
as well,
think about
right?
that.
So we also have this process, and we also have to do the same thing. We have to refine our pitch. We have to help people understand why we're uniquely positioned to do what we do and to drive returns for our investors. And then we manage those investors post-investment, like we just talked about. And then we have the other side, which is we have our own business, right? So we are, we're making hires, we're deciding on our real estate.
You're running a business.
Yeah, we run a business as well.
Yeah.
And so, and as my career has evolved, I'm spending more time on the business running side, more time on the fundraising and kind of management of our existing investors. But at the end of the day, I love investing in companies and working with founders. And so I try to make sure that I'm still doing that as much as I can.
Is there a Cinderella story where, like, rags to riches of somebody and your emotion when someone makes it and they know? Like, is there a point where you're like, oh my gosh, this is huge?
Yeah.
Is there a point and you feel it and and you're working with the founder and you're like, oh my gosh, that energy, we're just going to blow up now?
Yeah. Yeah, I think where I saw that, and there's probably a couple of examples we can talk about, but where it was most obvious for us, and partly because it's a consumer business, and so we could see the energy and the momentum, but was when we invested in Allbirds. So we invested in Allbirds. They were a year away from formally launching when we invested, but they did a good job creating momentum for the brand and the product before launching. And so I remember it pretty vividly because we had our annual meeting with our investors in April, and they had just launched in March. And the first month they launched, they did $12 million of revenue. So it was like, they
primed that pump.
Yeah. So $1 million of revenue, but they were clearly on path to do 12 to
12.
15 million of revenue
That's
that
still
first
crazy.
year. Yeah, I mean, to launch that first day, in fact, didn't really have, they purposefully invested up front to have enough SKUs. They wanted to have a big launch, but they still,
They were probably top 50 on the Inc. 5000 or something really high.
yeah. And so from there, it just took off. I mean, the revenue growth was phenomenal. The response from consumers was really exceptional. And then there was a moment in time, I think maybe it was the second year of business for them. So it would have been kind of 2017. The New York Times did an article, and front page of the New York Times headline was "Most comfortable shoe in the world."
Wow.
Share
And
that
a picture
feeling.
of Allbirds. And at that point, you could just tell, like, there was a tipping point. It already started. And credit to the team for, getting in front of the New York Times staff, doing that earned media, and getting in front of the right folks. And it did. It just, you could just feel the momentum, and it just continued
beautiful.
to grow.
You
Now,
tell-
every business has challenges, I think. And since going public, Allbirds has had more challenges
Yeah.
in their business and business model. But that was a really phenomenal story that really kind of, the momentum was just palpable. You could feel the pull into the market. Product market fit was so strong. It was just fun to be a part of. And
So-
really challenging on the flip side for them
Fulfillment
to fulfill, right?
Yep.
It's one thing for a software company to
to scale.
2-3x.
Yeah.
It's
a different world
You
and
have a
product.
plan, and then you beat it by 2-3x, which very, very rarely happens.
Yeah.
And it's one thing for a software product to do that. It's another thing for a physical
Yeah. It's
product with
not-
business
not
with
always the
physical
best.
product.
Yeah.
It's a lot of work to figure that out, and so the team just did a phenomenal job.
Well,
along the
Joey's
way.
on sabbatical, so next time he gets off sabbatical, you tell him, I need him in this chair because I want to talk
Okay.
Allbirds.
Okay.
Okay, so I'm going to end this kind of on a less, I guess, less serious note or whatever. But you had mentioned Cinderella Man, and actually, before you came, Ben was telling me that Cinderella Man is his favorite movie, which is kind of cool. Which is interesting because I think the last time we asked this question, I don't remember who it was, but the CEO said Cinderella Man, and I've noticed that there's very similar shows that founders like. It's very interesting. So outside of Cinderella Man, I'm going to ask you two, favorite movie.
Yeah, it's a good question. I'm not a.
It's not a fair question, I
Yeah.
feel. Like, there's so many genre.
Okay,
what
let's
kind
talk.
of mood
let's,
you're in.
let's talk genre. Favorite, based on historical, like a real true story. What's your favorite in that category?
You put me on the
You're
spot here.
totally
I'm
putting
not a
on.
movie
I was just going to say
connoisseur.
Top Gun.
Top
and
Gun's amazing.
I
Twisters.
was going to say Top Gun.
Did you go to
Thank
Twisters?
you.
That was
gonna-
crazy.
That was awesome.
Yeah, that was pretty crazy.
Top
Actually
Gun
did.
Maverick.
Top Gun was like one of my favorite movies growing up.
And the new
Right?
Top Gun's the best movie ever made. Period. This is end of story. It's
Yeah,
incredible.
I mean, I think part of it is I'm always inspired by, and I think to your point around entrepreneurs and alignment,
Yeah.
I'm inspired by not only high achievement
Yeah,
in doing great things, but the process that is required to get there.
that's right.
Against all odds.
Yeah, and I'm unabashedly an underdog fan,
Yep.
which may or may not be good as an investor, but I think when you can deal with movies and opportunities and real life stories of dealing with the uncertainty, the challenge, and finding your way through it. I think ultimately that's the story of entrepreneurs.
Yeah.
Ooh, like the Michael Jordan movie. It wasn't Michael Jordan. It was the Nike.
Yeah.
You know what I'm talking about,
Yeah.
right? It's kind of a documentary. Or the Hot
interesting.
Cheetos. Like, and that
Yeah.
became something big, and
Yeah.
you don't think.
Yeah.
But it was someone's passion and idea, and it became something. Like, we
Yeah.
all eat the Hot Cheetos now.
Yeah.
At least my kids do.
Well,
Absolutely.
I appreciate both of y'all coming on
Yeah.
and spending some time. Obviously, I mean, Peterson Ventures, Peterson Partners is a big, big name in Utah and beyond. And we're certainly proud of what you guys have done. And it's pretty inspirational for a lot of brands knowing, whether it's software or in product, that there's people that can help them to the next step. So I appreciate what you've done. Saray, you're amazing. Thank you so much, and taking time away from Good Things Utah.
Volcanic Retail is a business-to-business desktop and mobile platform that connects buyers and sellers. Think of it as a highly sophisticated dating app for your business. It's a 24/7 trade show marketplace and so much more. Send direct messages to buyers, view their buying calendars, and fulfill orders all through our platform. Create your own unique company page, tell your company story, and showcase your trending products. Communicate directly with buyers through Volcanic messaging. Send connection requests to buyers to form lasting professional relationships and stay up to date on retailers' buying seasons. VolcanicRetail.com is an easy and convenient management tool. You can get your product in front of the right buyer who is looking for exactly what you have based on MSRP, margin, ingredients, fabrics, certifications, style, color, channel, trend, country of origin, MAP, sale through. You get the gist. This year, thousands of companies spent their marketing budget on trade shows that got canceled at the last minute. Volcanic came up with an inexpensive, long-term solution that can't be canceled. Planes have been grounded, and in-person meetings and trade shows may become a thing of the past. With Volcanic, you have 24/7 access to the best marketing tool in retail. On Volcanic's marketplace, both you and the buyers can view your products from the comfort of a desk, at your home or office. Volcanic streamlines the retail process by showing awesome products to buyers that they're actually interested in. The rest of the buying process is simple and efficient on Volcanic. No more weeks of talking back and forth just for a deal to fall through at the last minute. It's time to step up your retail game. Click the link to get your free account today.